Wow, yeah, let's face it, markets are bleeding. What we expected to be something we will not see in 2022 is actually happening. And people have been calling on the crash, on a bear market, and we might already be in a bear market. But I want to share with you something, some facts, some data that will actually change your perspective if you're kind of worrying about stocks, if you're worried about where to put your money to work, if you're worrying about investing in this bear market, because the reality is it feels weird, it feels stressful, it feels depressing to see your portfolio dropping week after week because as a matter of fact, the last 6 weeks, markets have been down every single consecutive week. So it is stressful, all right? Now, because some people may not be at the same level of capacity when it comes to investing week in, week out, or monthly, or even quarterly, it's still very important to look at something that will determine where you need to be or what you need to take as action today so that your future self will thank you when you look back at this and you will laugh because you remember how panicking people were and you take advantage by positioning yourself well today. Look, folks, looking at the one day, things may look bad. Looking at 5 days or so a week, things may look bad. 1 month, 10% down. 6 months, 14% down. But since the year started, we are like 17% down. This is the S&P 500 I'm showing. Now, usually we will call a bear market when this thing hits 20%. So we are not there yet, which tells me we might not be out of the weeds because I believe depending on how inflation comes in on Wednesday, of this week, that will determine whether or not, the major risk in terms of what the Federal Reserve might do, all right? Or how the economy, where the economy might be heading towards, will actually, impact people allocation, people putting money to stocks. Because if inflation is still very, very high and the report comes around maybe, more than 8.6%, which is kind of the expectation, well, it means that it is not going to back down anytime soon. And if the Federal Reserve will have to be as aggressive as it should be, and that means cost of investing, cost of doing business, cost of borrowing, cost of, maintaining debt will remain very, very high. And that's the reason why stocks have been selling off since the last 6 weeks. Now, if it comes a little bit below, the 8.6%, then people are going to be relieved, like, okay, finally, this is starting to smooth down. This is starting to go down a little bit, meaning that the Federal Reserve might not be as aggressive. So the party can continue, even though the party has already stopped since the beginning of this year, if you see what I mean. Now, as an investor, whether you're beginning, whether you are experienced, whether you have 10 years of investing, you still need to see this as an opportunity because when you zoom out on the 5 years, for example, market always recover. Markets always recover. Keep that in mind. Why markets always recover? Because opportunities, environment like this where the risk of what is causing the risk into people selling their stocks will smooth out, will get obsolete, will get fixed, and they will realize that with prices getting back down, with stocks that are down like 80%, some are even down 90%, it will make sense to start putting my money back into stocks because ultimately, let's face it, folks, if you put your money in the bank right now, you're earning nothing. So it's either stocks, real estate, crypto, or bonds. But everything is crashing now, which is kind of my point here. Now that people are always everywhere panicking, if you have some money left over, if you have some money on the sideline, if you have some money that you don't need for the next 12 months or for the next 25 years, then it's a very interesting entry for you because if you bought here, even with this drop here, you will still be up on that investment 73%. Every time the market go back down for whatever reason it might be, people taking profits, war, inflation, Federal Reserve, whatever it might be, Even COVID, markets always tend to recover. All right. So it will not be different here. The only difference might be the amount of time it will take to get us there. But as an investor, especially if you are a long-term investor, if you don't need the money for the next 2 years, 3 years, 5 years, 10 years, 15, 20, 30 years, this is the right time to do what we call dollar cost average, because dollar cost average gives you the ability to buy when it's high, when it's low. But for you, you might say, okay, well, when is the right time to buy? Well, the right time to buy is now that stocks are down, because as they go up, you ride the wave back up, and that's how you make money. And the fact that you are buying at consistently, regularly, you're accumulating. So your position size is growing and growing and growing. And with time and interest rate compounding, that is how you are building wealth. So that is, to me, the best way to invest in a bear market. Even though we might not be there yet, but we are already in the market with a downtrend. So that is what I've been doing on my, Roth IRA and 401k and some of the stocks on my brokerage account, for the next 1 year or so, because it gave me the ability to reduce my base cost down. Now, if you don't have any cash on the sideline, and you are already invested in some of the stocks, if you are not using your margin levels, well, just wait. Just be patient, because the reality is, as I mentioned earlier, stocks always recover. It may not be as soon as you want it to be, but truth is, they always do.